Most traders focus on entries, indicators, and setups, yet still struggle to trade with consistency. What separates professional traders from everyone else is not a secret indicator, but a clear understanding of market structure, order flow, and how price behaves around key levels. Welcome to the ComLucro channel. In this video, we break down how professional traders approach the market using structure, supply and demand, and liquidity concepts to build high-probability trading decisions. We will start by explaining the core mechanics that drive price behavior, and then connect that understanding to a structured execution model you can apply step by step. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before any trading strategy can be applied with consistency, it is essential to understand where liquidity sits, how it develops, and how price responds when that liquidity becomes the objective. This foundation is what allows traders to move away from guesswork and start reading the market with structure and intention. To begin, liquidity can be classified into two main types: static liquidity and dynamic liquidity. Let's briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave, consisting of a high and a low. These highs and lows represent external liquidity. External liquidity pertains to the highs and lows within a rally wave. Conversely, the fair value gaps found within the range of the high and low are considered internal liquidity. Price in the market always moves between internal and external liquidity. Think of it as a continuous cycle where price moves either from internal to external liquidity or from external to internal liquidity. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. The price then transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity swept, the price then aims to balance by targeting internal liquidity. This causes the price to drop and fill the most recent fair value gaps. Shifting our focus, let's examine the details of static liquidity. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, such as below equal lows and above equal highs, above swing highs and below swing lows, below or above dynamic trend lines and channels, inside order blocks, below or above support and resistance levels, in Fibonacci retracement levels, and near the daily candle's body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting these zones can lead to substantial losses. Some liquidity areas are especially important because they are widely recognized by traders, which causes stop losses and pending orders to cluster around them, increasing the likelihood that price will move toward these levels to absorb liquidity. However, identifying where liquidity rests is only part of the equation. To truly understand how price moves, we must also understand how liquidity interacts and evolves over time. Internal and external liquidity together make up what we call dynamic liquidity. This is the true engine behind price movement, driving price higher, pulling it lower, or at times misleading traders along the way. Dynamic liquidity explains how liquidity continuously moves and adapts throughout the market. Think of it as a cycle. Price is always rotating between internal liquidity and external liquidity. It moves either from a high or a low toward a fair value gap, or from a fair value gap back toward a high or a low. This rotation represents the fundamental rhythm of price behavior. Once you recognize that rhythm, your perspective shifts completely. You stop resisting the market and begin aligning with it. Dynamic liquidity is the force that pulls price forward, and understanding it gives you a strong edge in anticipating both direction and timing. Within a trading range, price typically targets internal liquidity first. That internal liquidity may take the form of internal highs or lows, or fair value gaps. As price approaches these internal objectives, inducement develops. And once that internal liquidity is taken, or the imbalance inside the fair value gap is filled, the market's attention turns outward. At that stage, price begins seeking the next external liquidity pool to expand into. When this occurs, previous liquidity is cleared, new liquidity is formed, and price becomes attracted to a new external target. That fresh draw is dynamic liquidity in action. So, if you are buying or selling inside the range without understanding this process, you are most likely doing one thing. You are providing liquidity, not taking it. This cycle plays out again and again across every time frame. Once you understand dynamic liquidity, you stop holding positions for too long. You stop aiming for invalid highs and lows. You stop forcing a directional bias. Now we arrive at the real challenge. You may be wondering how we determine where price is likely to go next. Will it push higher to take upper external liquidity? Or will it drop lower to collect lower external liquidity? To answer that, we must pay close attention to how price reacts when it enters fair value gaps inside the trading range. This is where directional clarity starts to form. When price trades into a fair value gap, respects it, and especially holds the midpoint while showing rejection to the upside, it is a strong indication that price is preparing to move higher, targeting upper external liquidity. On the other hand, when price shows no respect for the fair value gap and drives straight through it without a meaningful reaction, that gap changes its function. It becomes what we call an inverse fair value gap, now behaving more like a resistance area. If price later retraces into that inverse gap and respects the midpoint again, this time with clear rejection, it becomes an early and powerful signal that the market is likely to continue lower, targeting the external sell-side liquidity resting below the trading range low. So what happens when price action inside the trading range is healthy and efficient, meaning there is no remaining internal liquidity to be taken? How does the market behave in that environment? As discussed earlier, price typically rotates between internal and external liquidity. However, when internal liquidity is no longer present, when price action is clean, balanced, and efficient, external liquidity becomes the primary force driving price. In these conditions, price begins to move directly between buy-side and sell-side liquidity. It targets major highs and lows where stop orders are most likely resting, rotating from one external liquidity pool to the next. This back-and-forth behavior continues until market conditions change, until a new inefficiency develops, a fair value gap forms, or a fresh inducement appears. At that point, internal liquidity comes back into play, and the full liquidity process is restored. Understanding this cycle explains why price moves the way it does. But understanding alone is not enough. The real edge comes from knowing how to apply this behavior in a structured and repeatable way. So, this strategy is built around three core components: a draw on liquidity, a liquidity grab, and the entry itself. For this setup, 2 time frames are used to execute the trade. On the higher time frame, key liquidity levels are identified and a clear draw on liquidity is defined. From there, we move down to the lower time frame. At that level, the goal is to spot a liquidity grab that aligns with the direction of the draw on liquidity. Once that occurs, the trade is executed, and both the target and stop loss are set accordingly. Before moving to the charts, it is important to note that this trading plan is not restricted to a single time frame. That said, the entry time frame should always be 2 time frames lower than the higher time frame. Based on your trading style, there are 3 time frame combinations you can apply. As an example, when using the 4-hour chart as your higher time frame, the 15-minute chart should be used for trade execution. Now, I will walk you through how this looks directly on the price chart. The first step is to identify a draw on liquidity on the higher time frame. But what does a draw on liquidity actually mean? In simple terms, it refers to recognizing a key liquidity level that price is actively moving toward. More often than not, the market is drawn to areas where liquidity is resting, such as equal highs, equal lows, or strong reversal points, because these zones contain a concentration of stop losses and pending orders waiting to be executed. These liquidity levels should always be marked manually on the chart. In this tutorial, the focus is on reading raw price action and applying smart money concepts without the use of indicators. By marking these areas yourself, you gain a clearer understanding of how liquidity forms and how price behaves around it. The next step is to zoom into a lower time frame and look for a liquidity grab that aligns with the direction of the draw on liquidity. With that in mind, let us move down to the lower time frame. Keep in mind that buy-side liquidity is positioned above current price. With that context, the objective now is to see a swing low taken out. In other words, we are looking for a bullish liquidity grab, which suggests a potential continuation to the upside. On the chart, this type of liquidity grab is identified directly through price behavior. A bearish liquidity grab occurs when price trades above a previous high but quickly falls back inside the range. This shows that buyers failed to hold higher prices, and that price was immediately rejected, pointing to bearish momentum. After this kind of move, a stronger push to the downside is often expected. In contrast, a bullish liquidity grab forms when price trades below a previous low and then rapidly returns back inside the range. This indicates that sellers were unable to sustain lower prices and that the market rejected that downside move, signaling bullish momentum. Once a bullish liquidity grab has been identified, the trade can be entered as soon as price returns inside the range. A more conservative option is to wait for price to continue moving higher to confirm the reversal, and then look for fair value gap formations to place a buy limit. If no clear fair value gaps are visible on the 5-minute chart, dropping down to the 1-minute chart can provide additional precision. Now, let us begin with a brief recap of the bearish setup. In a bearish scenario, the first task is to identify a key liquidity area that price is moving toward. This may be a previous low or a level where a large number of stop losses are clustered. These zones tend to draw price in before a reversal takes place. Once that area is defined, move down to the 5-minute chart. At this stage, wait for price to push above a recent swing high and then quickly return back down. This behavior indicates that liquidity has been taken and that the market may be preparing to move lower. After this confirmation, enter a short position and place your stop loss above the high created by the liquidity grab. Allow enough room for price to fluctuate and avoid placing the stop too tight. For your target, focus on the next clear sell-side liquidity level. This approach keeps the trade structured and intentional. Before we wrap this up, there is one more concept that brings everything together. Liquidity explains why price moves, and this strategy shows how to trade that movement. But market structure provides the context that allows both to work consistently. That is why I want to share a short clip from another video linked in the card. In this video, we break down market structure and explain how to identify whether the market is trending, consolidating, or transitioning. This understanding will help you apply these concepts with much more precision. Now, let's get started with the market structure. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.